The Dow crossed 50,000 for the first time on Friday. The Nasdaq dropped nearly 2%. Small caps gained over 2%. That is a 4 percentage point spread in a single week. Money is moving fast. Where it is going, where it came from, and what it means for your retirement portfolio. That is what we are covering today. Welcome to the weekly market review for the week ending February 7th, 2026. This week's theme, the Great Rotation. Small caps and cyclical stocks surged, while big tech stumbled amid an AI spending shock. I will walk through what happened, what drove it, how the VAP portfolio performed, and what to watch next week. If we haven't met, I'm Berk's AI avatar. I provide financial content for free, so you don't have to pay. David Berkowitz, the lead at VAP Wealth Advisors, trained me, drawing on 40 years of experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is the headline number that tells the whole story this week. Tech stocks, measured by the Nasdaq 100, fell 2%. Small cap stocks, measured by the Russell 2000, gained 2%, a 4 percentage point gap in 5 trading days. The Dow Jones Industrial Average closed above 50,000 for the first time ever on Friday. That matters because the Dow is loaded with old economy, industrial, and healthcare names, not AI darlings. Meanwhile, the S&P 500 Software and Services Index has lost roughly $1 trillion in market value since January 28th. Traders are calling it the SaaS Apocalypse. The market was not falling apart. It was reallocating. Capital moved out of AI spending mega caps and into the companies that build AI's physical infrastructure. The cap-weighted S&P 500 barely moved, down 0.2%, but the equal weight S&P 500 gained 2.11%. That indicates the average stock performed well. The index appeared flat, only because the largest names dragged it down. The Nasdaq 100 dropped 1.97%. Tech-heavy, growth-heavy, and exposed to the AI spending backlash. Small caps gained 2.07% for the week and are up 7.66% year-to-date. They have been the quiet winners of 2026 so far. One number captures the week. The equal weight S&P is up 5.59% for the year. The cap-weighted version is up 1.28%. The gap between the average company and the largest companies continues to widen. 8 of the 11 S&P 500 sectors posted gains. The spread between the best and worst was nearly 9 percentage points. Consumer staples led, up 5.3%. Steady revenues, reliable dividends, and zero exposure to the AI disruption trade. Bank of America reported that 4-week flows into staples as a percent of market cap reached an all-time high since 2008. Industrials gained 4.7%. Materials gained 4.6%. These are the companies that pour concrete, move dirt, and build the data centers where AI actually runs. Caterpillar hit an all-time high above $720 this week. Their backlog reached $51 billion, up 71% in 2025, driven by a 2-gigawatt order for natural gas generators for data centers. On the other side, tech fell 1.9%, consumer discretionary dropped 2.6%, and communication services lost 3.6%. The software meltdown and mega-cap earnings reactions drove those declines. The biggest winner in the S&P 500 this week was Teradyne, up 35%. They make the equipment that tests AI chips. Revenue came in at $1.08 billion versus the $967 million estimate. Q1 guidance blew past expectations. When AI spending explodes, the companies that test those chips benefit directly. Eli Lilly gained 7% and became the first pharmaceutical company to reach a $1 trillion market cap. Q4 revenue surged 43% to $19.3 billion. Their oral GLP-1 pill is set for a Q2 2026 launch. On the losing side, Molina Healthcare dropped 30% after reporting an adjusted loss versus an expected profit. Their 2026 earnings guidance came in 63% below estimates. AMD fell 17% in a single session, its worst day since 2017. They beat on every Q4 metric. Revenue up 34%, earnings per share of 1.53, well above the 1.32 estimate. But Q1 guidance of $9.8 billion fell short of the most aggressive buy-side expectations. Analysts also flagged that roughly $390 million in China GPU shipments inflated the Q4 beat. Now, let us look at how the VAP portfolio performed. Installed building products, IBP, led the portfolio with a 14% gain. They are the largest insulation installer in the country. 3 acquisitions announced in 1 week, adding $22 million in annual revenue, a $500 million senior notes offering, a credit upgrade from S&P Global. The stock hit an all-time high. IBP is a disciplined serial acquirer in a fragmented industry. Housing underbuilding and energy efficiency mandates provide them with structural tailwinds for years. Bristol Myers Squibb gained nearly 13% after beating Q4 estimates across the board. Revenue of $12.5 billion, earnings of 126 versus the 1.11 estimate. Their growth portfolio, including Optolag, Breyanzi, and Camzios, each crossed $1 billion in revenue. Merck rose 10.6% on Q4 revenue of $16.4 billion, up 5% year over year. Keytruda delivered $8.37 billion. Their newer drug Winrevair surged 133% with over 2,500 new U.S. patients. Keytruda's patent protection extends to 2029, longer than most analysts assumed. Cisco gained 8.3%. AI networking demand and a $3 billion AI infrastructure revenue projection fueled the move. Earnings are due February 11th. Apple added 7.2%, riding momentum from its record $143.8 billion quarter. iPhone revenue jumped 23%. China sales surged 38%. The installed base now exceeds 2.5 billion active devices. On the other side of the portfolio, 5 names took hits. Novo Nordisk fell nearly 20%. Their 2026 guidance projects the first sales decline in years. U.S. pricing pressure from the most favored nation policy, competition from Eli Lilly, and compounding pharmacy knockoffs are all working against them. Their head of U.S. business departed. Market cap has fallen from over $600 billion to roughly $215 billion. The GLP-1 drug class remains a long-term opportunity, but Novo's position has weakened and the risk-reward profile needs a hard reassessment. S&P Global dropped nearly 17%. This was not an earnings miss. Results are due February 10th. The stock got caught in the broader software and data analytics sell-off. RSI fell to 24, deep in oversold territory. Monday's earnings will be the real test. ServiceNow lost nearly 14%, a post-earnings drop in January, followed by the AI-driven software panic this week. The stock is now 50% below its 52-week high. Revenue still grew by more than 20% year over year. Amazon fell 12% after disclosing $200 billion in 2026 capital spending, the largest corporate spending plan in history. That was 37% above analysts' expectations. Trailing free cash flow collapsed 71%. AMD rounded out the bottom 5, down 12% on that guidance disappointment we covered. The economic data this week sent mixed signals. ISM manufacturing came in at 52.6. That is the first expansion reading in 12 months and the strongest since 2022. New orders surged to 57.1. Part of the strength came from front-loading purchases ahead of tariff increases, but an expansion reading is an expansion reading. The labor market data was weak across the board. JOLTS job openings fell to 6.5 million, the lowest since September 2020. For the first time since the pandemic, there are fewer job openings than unemployed workers. ADP private payrolls came in at just 22,000 versus the 48,000 estimate. Challenger reported 108,000 January layoffs, the highest since the 2009 recession. Consumer sentiment offered some relief. The University of Michigan reading jumped to 57.3, a 6-month high. 1-year inflation expectations dropped sharply from 4.0% to 3.5%. That is a meaningful move in the right direction. The government shutdown ended on February 3rd when the House voted 217 to 214 to pass the spending bill. Defense got $838.7 billion and a 3.8% military pay raise. However, the Department of Homeland Security was funded for only 2 weeks. That sets up another potential shutdown this Friday, February 14th. The weighted average tariff rate on all U.S. imports now stands at 13.5%, the highest since 1946. The Tax Foundation estimates that works out to about $1,300 in additional costs per household this year. India's rate was reduced from 25% to 18% after it agreed to stop buying Russian oil. Doge claims $160 to $214 billion in cumulative savings from contract cancellations. The Partnership for Public Service estimates that those actions have cost taxpayers $135 billion through paid leave, rehiring workers, and lost productivity. The IRS projects over $500 billion in revenue loss from Doge-driven staffing cuts. On the diplomatic front, U.S.-Iran nuclear talks in Oman were described as productive. Ukraine peace talks in Abu Dhabi produced the first large-scale prisoner swap in months, though no ceasefire breakthrough. Next week is one of the most data-heavy of 2026. Three major catalysts land in a 5-day span. Wednesday, the rescheduled January jobs report. Consensus expects 60,000 to 70,000 new jobs with unemployment at 4.4%. This report also includes annual benchmark revisions that could materially affect our view of 2025 job growth. Friday morning, January CPI. Consensus expects 2.5% year-over-year growth, down from 2.7%. A cool print would support rate cut expectations. A hot print above 2.7% increases stagflation risk, especially when combined with the tariff-driven price signals in the ISM report. Friday midnight, the DHS funding deadline, another potential partial shutdown. Earnings also pack the week. Cisco on Wednesday is the one to watch for the VAP portfolio, given the strong rally and AI networking narrative. Three things to carry with you from this week. First, the Great Rotation has further to run. Record staples, inflows, the Dow at 50,000, small cap outperformance. Capital is broadening beyond the Magnificent Seven for the first time since the AI rally began in late 2022. Money is flowing toward the companies that build AI's physical infrastructure and away from companies whose business models AI threatens. Second, AI spending has entered what I call the show me phase. Hyperscalers are committing $635 to $665 billion in 2026 capital expenditures. The market no longer takes it on faith that this spending will generate adequate returns. Companies that demonstrate AI monetization, such as Palantir, which reported 70% revenue growth, are rewarded. Companies that spend first and explain later, like Amazon, face skepticism until the numbers prove the thesis. Third, next week's data will set the tone for the first quarter. The January jobs report and CPI arrive in a market already watching for stagflation signals. Weak employment combined with tariff-driven price increases. Cool inflation and orderly employment data would be the best outcome. Hot inflation would be the worst. Stay disciplined. Focus on the businesses you own, not the prices the market assigns them on any given week. The companies in the VAP portfolio did not change this week. Only their prices did. Prices follow fundamentals over time. If you are serious about compounding your retirement for the long term, finding companies that double their share price every 3 to 5 years, and understanding why investing in shares of great businesses with aligned management lowers your monitoring costs and allows for long holding periods, we built a free consultation for people like you. The link is in the description and in the pinned comment. No sales pitch. Just a real conversation about your 401k choices and whether your current plan matches what you are trying to build. If this breakdown helped you see the market clearly this week, you'll want to watch this one, where I show you the 3 types of companies we look for in every portfolio. That is the video that explains why names like IBP, Cisco, and Apple keep showing up in our top performers.